Hi everybody, welcome back to another video. In this video, we will go through 4 REITs results and see what is their difference in their performances. Even though interest rates are expected to drop, we will see why FLCT is expected to continue experiencing higher finance costs on their debts, while the other 3 REITs' finance costs might have peaked. For people who are not familiar with FLCT, they are a REIT which has 72.4% logistic properties, which makes them very attractive compared to other REITs. However, having good properties is not only the factor when it comes to managing the REITs. It's important to ensure that the debts of the REITs are managed well so that the finance costs would not increase that significantly in times of high interest rate. That is the main problem that FLCT has been facing. Their current leverage ratio is at 36.1% with average cost of debt of 3%. Their borrowing costs have been increasing due to the refinancing of the cheap debts. Back in 2022, I've already flagged out that in the financial year of 24, 25 and 26, if interest rates are not coming down that fast, the refinancing of these loans will definitely be more expensive. This is because the debts were taken at a period where the interest rates were lower, thus refinancing will essentially renew at the current interest rate market. So far, they have refinanced 340 million of their debts for this financial year, with the remaining 395 million that needs to be refinanced. This impact will be huge in their balance sheet. With the refinancing, their finance costs increased significantly by 35% year over year, even though revenue and net property income is up. The increase in finance costs is too large that it resulted in a drop of 13.8% in their dividend. This is why it's very important to look into the REIT's debt maturity profile to understand whether they are making any actions to refinance those early debts. Unfortunately, no actions were taken which resulted in this current moment that was expected. Unfortunately, as interest rates still remains high, the refinancing of the remaining debts in the financial year of 2025 and the debts in 2026 might continue to result in higher finance costs. Rental reversions are the new leases signed by tenants renting their properties. Positive would mean that the new leases signed by tenants are at a higher rate, giving REITs higher income. Logistic properties continues to perform well with 8.7% positive rental reversions. However, commercial continues to perform badly with negative 12.5% for Singapore leases. This will be something to look into as most of the leases in financial year of first half 2025 is commercial leases. With logistic properties having positive rental reversions while commercial having negative, it's important to see that investors should prefer logistic leases to expire but not the commercial. This is so that logistic leases will be renewed with higher income while commercial leases that are renewed with lower income. For this financial year, unfortunately, not a lot of logistic leases needs to be renewed. With no acquisition or properties coming online through enhancement, I do not expect much changes to their income. So what can we conclude from FLCT's earnings? There's a wide difference in the performance between the logistic and the commercial properties. Second is the raising finance costs might be expected due to the refinancing of financial year 2025 and 26 debts. With income being stable while finance costs increasing, I feel that there will definitely be a huge risk for lower dividends expected. FLCT share price continues to crash, and this is not surprising considering their dividends will be expected to continue dropping. With this huge drop in dividends, their dividend yield might be around the range of 6.9% even at this low share price. Therefore, cheap REITs might not translate to good value. Even when it drops from 46.1% from its high, as investors, it's important to know the reason for the drop. Now let's go on to the next REIT, and that is Fraser Centrepoint Trust. FCT is very similar to CICT due to its pure retail properties in Singapore only. This makes them very valuable because retail malls in Singapore have been doing well compared to overseas. So far, they have 11 properties with some of the most popular malls being majority of their portfolio from NEX to Tampines 1 to North Point. Looking at the key highlights, retail occupancy is very good while the very important parameters are doing decent with shopper traffic up 1%, while tenant sales are up 3.3%. Like I always said, these two parameters are very important in ensuring that tenants are willing to stay rented in FCT properties. If you think about it, I'm sure no tenants will want to rent a spot in the shopping mall when they are not earning money. Rental reversions are good at 9%, and another good news is that their cost of debt went down from 4% to 3.9%. On top of the good news, revenue and NPI both went up thanks to the complete enhancement of Tampines 1. With Tampines 1 being a huge contributor for FCT, this is definitely good news for shareholders. With the drop in the cost of debt and the increase in income, their DPU increased by 0.5% year over year, partially offset by the share dilutions. If we look at their debts, both leverage ratio and cost of debt dropped. Similar to CICT, their cost of debt might have peaked, which is good for shareholders. For this financial year, they have no debts to refinance, while they have 22.1% of debts that needs to be refinanced in year 2026. However, I feel that there's a chance that this refinancing will not increase their finance costs, as their cost of debt might have peaked. FCT is also making another big acquisition to buy the remaining ownership of North Point City. If you have not been to North Point, it's one of the most popular malls or crowded malls they have been to. It has expanded a lot but still managed to attract a lot of shopping traffics, making it a very desirable mall to own. I feel that this acquisition is fantastic, and we will see how it helps with the DPU, as there's definitely share dilutions due to private placements. So what can we conclude from FCT's earnings? Overall, FCT has been doing well with debts peaking. We should expect to see higher DPUs in the subsequent halves, which is good news for shareholders. At the current share price, it's slightly pricey at a dividend yield of 5.36%. Next, let's have a brief analysis on OUE Reit. OUE Reit is a small REIT that consists of just 6 properties in Singapore, with office at 50%, hotel at 33%, and the remaining at retails. Looking at their key highlights, revenue and NPI both dropped by 12%. However, this was because of the divestment of Lippo Plaza Shanghai. Comparing like-for-like basis, revenue and NPI still dropped slightly in the 4% range. Good news is that their finance costs dropped by 11.3% year over year. Office have healthy occupancy with high rental reversions of 9.9%. Hospitality sector experienced lower revenue per available room as it dropped from $277 to $248 per room. This would be one of the segments that continues to cost lower DPU for OUE Reit, as 20.8 million would mean that first half would be only 42 million. Retail property performed decently with positive rental reversion of 4.9%, but it was weaker compared to last quarter's results. Even though finance costs dropped by 11%, their NPI dropped significantly by 12.1%. With the income dropping faster than the drop in finance costs, I'm afraid that the DPU will be lower for this upcoming quarter. If we look at their debts in the balance sheet, the surprising thing is that with the sale of the Lippo Plaza, I was expecting them to use the funds to pay down the debts. But based on the first look, it seems like they didn't do that. In the last quarter's dividend, what stands out the most is the share of joint ventures results, increased by 105% due to the fair value gains with its partner. However, this increase was unsustainable as this quarter just came in at 3 million. Moreover, the last half's dividend was also boosted thanks to the divestment gains. Debt-wise, it was disappointing as the debts increased from 39.9% to 40.6%. Good thing is that their average cost of debt surprisingly dropped by a large 0.5%. So even though they have more debts now, at least the cost of debts has dropped, resulting in a large drop in the finance costs. So what can we conclude from their results? Office and retail properties perform decently, while the hospitality sectors are seeing some red flags. With the drop in the income and the exclusion of the divestment gains, I would expect their next quarter's dividends to come in lower. High leverage ratio and finance costs might continue to be a risk for OUE Reit. At the current share price, its current dividend yield is at 7.2%. Next, let's go on to ESR Reit, which provided business updates. There are REITs with 72% properties, with Singapore holding the majority of the assets at 83.7%. Most of the asset class is in the logistic properties, which tends to do well in most countries. Looking at their key highlights, both revenue and NPI is up double digits. It's actually due to the additional acquisitions. So even though distributable income is up, we have to see how the share dilutions affect their dividends. At the moment, 44 million for Q1 is much better than Q4 last quarter. Rental reversions is good at 8.6% positive, which is important for the organic income growth. Gearing ratio is still high at 41.9%, and their cost of debt, similar to OUE Reit, has dropped by 0.2%. For their rental reversions, it's impressive with logistics coming in strong at 13.2%. Even though occupancy in Singapore may not be good, it's good to see that their overall positive rental reversion is still going well. This means that their properties are still in demand. For their debts, the problem is that they still have a high leverage ratio of 41.9%, even though some of their debts have been paid off. Hopefully, we can see lower leverage ratio as they divest away some of their properties. In the debt maturity, they share good news. Financial year 25 loans were refinanced at lower margin, while financial year 26 are expected to refinance at lower margins as well. So this is another way to see that interest rate might have peaked for ESR Reit. So what can we conclude from this quick analysis? Properties of ESR Reit are doing well with good occupancy and high rental reversion rates. However, gearing ratio is still a concern at 41.9%. But even with this high leverage ratio, cost of debts are expected to drop, which will be beneficial for the shareholders. At the current share price, its dividend yield is around 10%, but do note the risk involved and why the dividend yield is so high. I hope this video gives a good overview on the differences in the performance between the four REITs. Overall, interest rates definitely has peaked, as you can see that the REITs are experiencing drop in interest rate other than FCT, which is a unique case because they are refinancing their very cheap debts. With the drops expected, hopefully it will bring down their finance costs and will be beneficial to shareholders' dividends. Thank you so much for watching. You can support my channel by using the affiliate links to get the rewards and open your brokerage account. There are also other analyses being done showing interesting results that you can see here. Thank you, and I'll see you in the next video.